Good morning, I'm Chris Beecham. Welcome to Charting the Markets on IG Live. It's a bit of a risk-off day to start with, particularly in US and European indices. The CAC40, notably, the big loser on the pack thanks to weakness in luxury stocks, which is a bit of a double-edged sword because they've been such strong performers over the past 2 months for the index. So that's knocking the index back a bit this morning. But back in London, the FTSE 100 actually holding up relatively well. And that is mainly down to some sterling weakness after PMI data this morning. It comes at an odd time because the IMF has just said the UK will avoid recession this year. But that positivity doesn't seem to be extending to the pound, which is weakening against the dollar. UK focused stocks in the FTSE 100 are rising particularly this morning. If you look at British Land and Land Securities, too heavily focused on retail and indeed UK office blocks, etc., actually doing at the top of the index this morning. Of course, while it is PMI day around the globe, we've just had Eurozone PMIs over the last couple of hours, which are mixed at best along with the UK ones. The main focus is still the debt ceiling. PMI day does provide a welcome distraction from the ongoing turmoil in the US, but it is still the main story, really. Otherwise than that, once you get PMIs out of the way today, the focus does shift back to the debt ceiling, although we do have NVIDIA earnings later in the week, and then also US inflation, not CPI, but PCE data, the Fed's preferred measure at the end of the week. So overall, a bit of a mixed start to the day, really. Risk has found it tough mostly to establish firm upward momentum. But overall, I think we're still looking at an environment where markets are just going to struggle for the time being until we get a resolution of the debt ceiling one way or the other. Starting with the indices, beginning with the FTSE 100 currently trading at 77.80. And you can just see how over the last 3 days, the index, last 3 sessions, the index has managed just to nudge its way higher. It's holding short-term trendline support from early May, so that's one thing to watch out for. And that still maybe puts us in with a fighting chance of moving on to test these recent highs from the end of April. It is notable that we are managing to sort of stall the run of lower intraday highs on the index that we've seen. And if you're looking at maybe trendline resistance from that late April high, we're now edging above that in early trading today and above the 100-day moving average, which is usually a good sign if you're looking for a continuation of the uptrend. You've also got a MACD crossover here, looks, or at least will be a crossover, should we perhaps get a positive close today, and then maybe gives the index the chance to correct the slightly negative view that has been created by the fact that you've had a lower high in April following on from February's higher high. So that's what we're looking for the index at the moment. Buyers still just about in control for this index. As I say, the weaker performance of the pound this morning giving FTSE stocks a bit of a lift. It's always a bit of a short-term effect, and the long-term effect is minimal at best, but certainly it's something you do see one day to another. Strength in the pound tends to see weakness in FTSE and vice versa. And this morning you've got weakness in the pound. That's helped the index just to nudge itself higher. And it's certainly the best performer out of most of the European indices this morning. They're finally seeing a bit of weakness off the back of most of the debt ceiling, but as I say, it's the CAC that's really taking on the nose this morning due to the selling in luxury stocks. If we flip over to the DAX, the big traded market, of course, this one finally, since I last spoke to you, has broken out of that trading range, which must have been intensely frustrating for everyone during the course of April and into May. A big digestion of gains we had here, and we did have a breakout finally last week, back above 16,000. Onto its highest level here, really now since we just, in fact, nudged an all-time high in trading last week, intraday high, and very holding on to that at this point in time. So it's overall very solid performance from this index. New higher highs, so the uptrend firmly intact here. Dip buyers from March can feel very satisfied with the work. And of course, if you look further back, there's your previous higher highs and higher lows, just cementing this bullish view. No real sign of that changing at this point in time, and just consolidating around those highs. The fact it hasn't immediately dropped back is always a good sign. The debt ceiling issue clearly affecting all markets, even those focused on Europe. So the DAX maybe just waiting to see what the resolution of that is. But volatility seems quite low. Over the past few days, you've seen the average true range for the index declining from that late March peak. So it's still a relatively quiet market overall, and that tends to, I think, favour the buyers over the medium term. If we flip across the US, of course, the Dow not very much in celebratory mood, to say the least. Really just sinking since mid-April at 34,000, really. And not surprising, of course, when you consider the debt ceiling and the worry that the world's largest economy could potentially be headed towards a default. Now, I think in some ways this is talked up by the US Treasury, and quite rightly, as a major event they want to avoid. That's not really necessarily the case that the world will be plunged into crisis come the 1st of June if nothing happens. There are ways probably that they can move things around to maybe give some more breathing room, but certainly it's an event we don't want to see happen, and the disruption that comes from that will not be pleasant. So that's why things like the Dow are certainly suffering. If we look briefly at the Nasdaq, that is, however, still very happy, sitting at its multi-month highs. But the Dow, as you can see, miserable at best. If you're looking at trendline resistance, this inside trend line from those December highs, we sort of oscillated around it over the past month or so. We did try and build a base off it several times. And you can look at 4 times you've had big intraday rallies back above the trend line. So there's clearly appetite to buy this market in many ways, but just is not able to hold on to it. Certainly stepping into weakness, but not able to drive it higher. Certainly not able to recover 34,000 in anything like a reasonable time frame. Sellers still have a bit of trouble because they're heading now into the zone where the buyers have really stepped in since the beginning of the month, around 33,000. It's been the line in the sand really for buyers, so this far and no further to the downside. So move below that and then onto the 200-day moving average would be the interesting development, certainly from the short perspective. And also because you've got trendline support coming through from those October lows, that's also coming up very quickly. So that's another thing to bear in mind. The last bounce off trendline support in March, which saw the Dow actually nudge to its lowest level in 5 months, then resulted in 2,000 point bounce. So we'll see whether that one can happen again, or whether this will finally be the moment where the sellers can wrest control, open the way to the move to the downside and onwards to 31,500, perhaps in the March lows. The obvious case is that if debt ceiling talks break down, that is what will happen, that we'll go to a very firm risk off phase for markets. And the Dow, as one of the laggards this year, really could be where we see a lot of the selling if people pile into the existing weakness in this index. And definitely something to watch as we head towards the 1st of June. The so-called X date is now being referred to in the media, just to give it an extra bit of excitement as we head towards this. Further negotiations continue today in Washington's worth noting, and into the rest of the week. Looking at FX markets, euro dollar really continuing to see a bit of pain here, slipping back below the 100-day moving average after rallying above it briefly yesterday. And as I probably said last week and the week before, it's perhaps odd to see the dollar rallying when debt ceiling is the only thing in the news at this point in time. But unsurprisingly, in risk off kind of moves, it's the dollar that sees benefit, particularly when we're looking at things like the euro. So after PMIs this morning as well, which weren't great, it has to be said, mixed at best, some beating, some missing expectations, further weakness creeping through in euro dollar. It finds itself below the 100-day moving average. It's back below the 50-day moving average. It's below that form of trendline support from the September low. So we are in a rather different place now than we were just a couple of weeks ago when the index was riding high up at 110, which of course is the nature of markets. But really with the potential for further declines, the next big area to watch becomes 105.40. That was the zone of support where the buyers stepped in at the end of last year and into March as well. So there's your line in the sand, if you like, which does obviously spell a bit of pain for euro dollar in the short term, perhaps, for the buyers to really suggest that this is still a higher low. And there is the potential for that. I think if it recovers above the 100-day and then maybe ideally moves above the 50-day, maybe it's not going to be quite the fatal move to break that trendline support. But if it managed to recover back above 106.80, 106.70, then you might say, oh, we're still just about in the higher low camp, and maybe there's another opportunity for this to revive. I certainly would argue that with the price above the rising 200-day moving average, it's really hard to take too bearish a view at this point in time. If we'd seen this continued decline over recent months and the 3 moving averages were turning lower, then fair enough, we'd be more bearish. But I think we've now shifted from being rightly bullish over the course of the past 2 months and certainly guardedly optimistic at these highs, but we've now seen it drop back. Price action is making us rethink our view in the short term, and perhaps now the sellers have got a bit more space to play with, and we might see it maybe head back, maybe in the direction of 105.40 and the lows from March. If we're looking at the pound against the dollar, again, more weakness coming through here. We're back now this morning below the 124 level, which was so important in the middle of December and into January. So that's an interesting development in and of itself. Falling back, of course, after the higher high in May, and we're back below the 50-day moving average, may not necessarily be the end of the world, but certainly perhaps some caution appears to be warranted at this point in time. So that's definitely something to keep an eye on. Further declines might take us on towards 122.80 and the 100-day moving average, really, and for it to establish a more bullish view above 125. I suspect that, as with euro dollar, the longer we have negotiation around the debt ceiling, of course, there's no sign they'll actually agree anything before the deadline, but the longer this goes on, the more we'll see dollar strength and just risk off moves, and that could bear down on the pound against the dollar even more than if we get, say, a bit of strength coming through from CPI data in the UK tomorrow. Finally, turning to dollar yen, more dollar strength here, though somewhat paradoxically. Japanese assets outside the yen have done very, very well of late. The yen weakness probably playing a part there, with export shares in the Nikkei doing so well. We're now above the 200-day moving average, back above these highs from the middle of March and the beginning of May. So the buyers firmly in control here, and now eyeing up perhaps some consolidation or some short-term moves towards 139.40, or indeed onwards towards the late November high around 142. After an impressive bounce from the lows of late March, it does look like the buyers are firmly in charge here. Slightly overstretched in the short term, I suppose, but as this rally begins to develop a life of its own, it could be argued that that becomes less and less important. I think we'd have to be argued for a move back below 137, back below the 200-day moving average, to really put a bit of pressure on this one in the short term. And for a more bearish view to develop, it'll have to go back below 135 lower, really. So the buyers more or less in charge on this one over the past few days, and still looks poised for further moves to the upside. Commodity markets, again, stronger dollar here, just hitting gold prices, and oil a bit uncertain really as well. Some oil commentary around the outlook is really not helping prices in the medium term. If you look at gold to start with, 2 days of losses, we're back to the lows of last week. And again, this is the stronger dollar making itself felt as well here. So the next thing to watch for, really, again, it's a case of watching for trend lines, or potential trend lines at least, because there's always another one you could draw slightly. But if you're looking at trend line support all the way back from November, we're getting very close to that. So undoubtedly, this is getting to somewhat of an interesting area for gold prices around the 1960, 1955 level, if you like. Still firmly in an uptrend, it needs to be stressed. Even if we go to 1900, it's still arguably a higher low. As we were saying over the past few weeks, bearish view in the short term needed a break of that trendline support from late March. That's what we got last week. So the sellers have had their chance. It's just a question of how much further it goes. Anything that goes back down towards 1880, 1870 still marks a higher low. I think it would have to go back all the way below 1800 to suggest that a much more negative view is prevailing here, and certainly the uptrend will take a lot of battering, I think, it to really knock that view out of the way. At the moment, we're still perhaps thinking, okay, some more downside, perhaps test of trendline support, and then maybe another bounce. Again, dollar weakness playing a key part. And if you get a resolution of debt ceiling, you probably would see dollar weakness, because people move back into assets like gold, euro dollar, and cable, and indeed stocks as well. And finally, US crude, rallying yesterday, but stuck this morning, really. Buyers and sellers equally unable to maintain control on this one. We saw it recover yesterday, but short-term moves to the upside have been very limited. We did see that last week. Last Friday, we pushed towards 74, but we struggled to get back above there. So clearly a bit of resistance coming through in this area, although it does find itself with some trendline support coming through from last week's lows as well. So an interesting short-term form here. Breakout from one of these could be developing, because the triangle formation arguably still coming into play here. Definitely the case that could be quite violent if we do get that move, a break either above resistance or below support. So do watch out for that. Still broadly in a downtrend, of course, but neutral view at best. I think if you get a daily MACD crossover to the downside, clearly that would reinforce a negative view back below 70, and you might get another test of these lows from March and indeed early May. So looking to the rest of the day, it's US flash PMIs this afternoon, finishing off the trip around the globe looking at economic data, and then really back to the debt ceiling, unfortunately. That continues to be the only real story affecting markets. We're expecting more negotiations day, but a weaker open expected for the Dow, as we were looking at a little while ago, down about 70 points from yesterday's close. That's it for me. Thank you for joining us, and we'll be back tomorrow at 10:30.